Do you think pensions are boring? Well, you might not be wrong, but here's the good news. I absolutely love pensions. So I am here for the next 10 minutes to make them as exciting as possible so that you can absolutely nail your investing for retirement. Because the truth is, the numbers speak for themselves. The sooner that you start with your retirement planning and investing, the better that your later self will have it. So in this video, I'm breaking down the 101 of investing for retirement, what that actually means, how to get a plan, and how to get started. Buckle up and let's go. So first things first, and it might sound obvious, but preparing for retirement isn't just about saving, it's actually about investing. Over time, if you just save in cash, then what you'll usually see is that inflation will erode away at those cash savings that you've got, because the rate of interest cannot outperform inflation over that longer period of your working life. Investing for retirement is about having a strategy and a plan to make sure that those savings that then become investments for the later stages of your life are growing, and so that when you stop working, your money does not. Now, depending on where you live, your pension options will look quite different. In the UK, for example, we have, in most places, some sort of employer pension. If you don't have an employer pension, let's say you're self-employed, then you can likely have something called a SIP, standing for Self-Invested Personal Pension. These, both the employer pension and the SIP, come with tax benefits. So they're a really nifty, easy place to start when it comes to your retirement planning and investing. If you're in the US, you've got your 401ks, your Roths and your IRAs, all of which come with tax benefits as well. And in Australia, there's the superannuation, which comes with similar tax benefits when it comes to retirement savings. If you're elsewhere in the world, the pension scene might look a little bit different. So it's always worth doing some research as to what kind of products are out there. Often the best and most reliable source of information, it might not be the easiest read you've ever made, is on your relevant government or tax authority's website. After that, you can start further research into the kind of product providers of pensions that you might find. Whichever country you're in, step one for absolutely everyone is find those old pensions. Track them down, whether it being through logging in, looking for old paperwork, or contacting old employers. Find those pensions, as I say, as step one. So how much do you actually need to put in? I'll do a whole other video on the calculations that can go into working out how much you need at retirement. These are quite complex, and as I say, I'd really like to break it down for you at a later stage. But one really simple rule of thumb to follow is to halve your age, and whatever that is, put in that percentage of your salary towards your retirement pension planning. This percentage, by the way, can include employer contributions as well, so don't forget to add them in. So with this rule of thumb, if you're starting at the age of 30, for example, you'll be contributing 15% of your annual salary. If you start at 40, it'll be more like 20%. If this feels like a stretch, don't panic. Just start with something, because something is still better than nothing when it comes to compounding and getting those investments working for your retirement. Right, now we've got to do the 101, the investing bit. Now, what you'll find is that the vast majority of pensions will automatically invest you into something known as Lifecycle or target date funds. What these funds do is that they automatically change assets as you move throughout your working life and approach retirement. The reason why they move their assets is because they're de-risking them. So they're taking them from higher risk at the beginning of your working life through to lower risk as you near retirement age. This will usually be done with a combination of equities or stocks or funds that are invested into stocks being the higher risk assets and the likes of bonds being the lower risk assets. Generally, when people reach retirement, they'll have a higher percentage of the likes of bonds in their portfolio because these generate a little bit more of a steady income, which is normally what you need when you get to that point. It might sound smart and simple, and for some people it works perfectly, but it's not quite for everybody. For some, it may well mean that their pension languishes in low-risk assets that then don't grow enough before they get to retirement age. It may also move you into these low-risk assets too early, particularly if you're somebody that's wanting to retire at a different age or stage, or if you've got other pension plans or other investments that are funding retirement before that specific one that is invested in that way. This is why first step is always to check the investments on your current pension. Have a look at the blend between equities and bonds and check that is aligned with your targets and that it's growing enough for what you really want to achieve. Now, if you're looking at building your own investing portfolio for retirement, you might take a look at these life cycle funds that I've mentioned that many people will find those existing pensions are already invested into. But you might also want to do it yourself. It might be an approach that you want to take, and that's absolutely fine. Many people approach this with the likes of low maintenance, low cost funds such as ETFs or potentially other mutual funds depending on where you are. They'll usually choose a blend, still a nice diversified mix of equities and bonds from across the globe. What these will often do is allow for some level of growth while also hopefully moving towards some stability depending on your age and stage. So remember, if you're further away from retirement, generally you want to be focusing on higher growth, higher risk assets. If you're closer to retirement, then what you want to be focusing on generally is more stable, more income yielding assets. In those growth assets, we might be focusing on the likes of more equities, perhaps stocks from higher risk sectors, higher risk regions. When you're approaching retirement, as I say, you might be focusing on those more stable assets. These could be things that include the likes of bonds that generate a steady income, or perhaps stocks that are in more developed markets and more developed sectors. Once you've got your retirement investing set up in that way, the next best step is to start to think about maintaining it. And here's the secret: the best investors aren't those that are checking in every day. When it comes to longer term plans like your pension, your best bet is just to have a look in once a quarter. Maybe once a year you start to change assets slightly, but it's not something that you need to be on top of here, there and everywhere every single day. When you do have an assessment, take a look at these 3 things. Firstly, check in on your contribution rate and see that it still matches up. Secondly, have a look at the investment performance and see that that's also in line with what you're wanting. Finally, take a look at that investment performance along with the assets you've chosen and make an assessment as to whether it's all still right or whether some need to be sold, bought, or moved into more appropriate assets for your age and stage. So that's your quick 101 of retirement investing. First step is check up on any pensions that you've already got and see where they're at. Next step is to work out your ongoing contributions. See how much you need to put away depending on your age and stage. Third step is understand those investments. Have a look at both those existing pensions and how you're going to structure your retirement investments going forward based on the age that you're at and how far retirement is away. Fourth step is make sure you maintain that diversification. Keep a mix of assets, be it through equities and bonds, that fit you. And last but not least, review this annually. Check in as and when you can to try and remain as diversified and on track as possible. You don't need to overhaul your entire life just to get your retirement investing sorted out. Just do one small thing today, be it log on to an existing pension portal or do the first bit of research into some investments that you can keep in your pension that might be right for you at this point. I'll end with one really shocking stat, which is that women in the UK retire with 50% less in their pensions. So don't be one of them. Get it under control, take charge, trying to say it all in one go there at the end of the video, because there really is a risk that your retirement won't look how you want if you don't. If you found this video useful, which I really hope you did, comment below with one step that you are going to take this week to get your retirement planning in check. And do make sure that you like and subscribe, because my next videos will be focusing firstly on making those calculations around how much you need to retire, and secondly, the 3-pillar structure that you can apply to your overall retirement planning. Thanks for joining and bye for now.